Hello, everybody. Welcome to OIC's webinar series. We're happy to bring you today a rebroadcast of a live presentation that we recently did. So enjoy today's session, and please be sure to stick around for a live Q&A following today's broadcast. Thank you for joining us. Welcome. My name is Mark Benzaquen. I am a principal of investor education at the OCC, Options Clearing Corporation. I am also an instructor with OIC, the Options Industry Council, who is the proud sponsor of today's money show event, the All Stars of Options. Let's go ahead and get right to it. Our standard disclaimer, I should mention that all of our slides are available if you want to shoot us an email address. I'll put our information up there shortly. You can shoot us an email, and we will get you a PDF copy of all of our slides. You're certainly welcome to take photos of anything that you see. But it is not necessary. If you want a copy of all of our slides, just shoot us an email and we'll be happy to get it to you. Standard disclaimer, options involve risk. As a matter of fact, there is a document called the Characteristics and Risks of Standardized Options. If you are opening an options trading account, you must receive a copy of this, and it would certainly behoove you to understand the information in there, because options do involve risks. And a prudent investor should know what those are. Trademarks that you're going to see throughout my presentation today, those being the trademarks of OCC, the Options Clearing Corporation, and the OIC, Options Industry Council. For today's presentation, it's going to be income, right? One of the reasons that people trade options is income generation. And when I'm talking about income, I don't mean a steady paycheck each and every month. What I'm talking about is simply earnings or returns that people enjoy from selling options. When you sell an option, or when you sell any good or service, any product, you get paid for it. When you sell options, you get paid for selling those options. We call that income, and there are certain strategies that are tailored to generating income, and that's what we're going to be talking about today. So we're going to go ahead and get started with call credit spreads, also known as a bear call spread. We're going to talk about put credit spreads, which is a bull put spread. And then we're going to put those together in an iron condor. And then we're going to kind of tweak it a little bit, and that's going to be our iron butterfly. So we start out with one, we add another, combine the two, that forms another strategy, and kind of manipulate it a little bit, and that becomes another strategy. And it really speaks to the flexibility of options, right? There's so many different things that we can do with them, regardless of our objective, regardless of our motivation, whether we're bullish, we're bearish, we're market neutral, whether we want to generate income or protect stock holdings, whether we want to use options to speculate. We've got that flexibility that options offer us. And part of that flexibility, part of those objectives, part of that motivation is that premium income we're looking to harvest from selling options. So let's go ahead and get started. Call credit spreads is going to be our first one. We call it a bear call spread. Different types of spreads. We've got vertical spreads, calendars, diagonals. But in general, a vertical spread is where we're buying one option and we're selling another option against it. Now, we can sell other assets against it, et cetera, so we can buy option and sell stock, for example. That technically is a spread. But with a vertical spread, we're buying one option and selling another, different strike prices, all within that same expiration date and obviously the same product. The two main types of spreads, we have debit spreads and credit spreads. A debit spread is just like any other thing that's a debit, right? You're paying money for it. And when we buy options, we are buying the right to do something. When we sell options, we're incurring the obligation to do something. So with a spread, whether it's a debit or a credit, where we're buying one option and selling another, we have both rights and obligations at the same time. With a debit spread, we're paying to initiate that position. When we buy something, we are in control. So when we're doing a debit spread, for example, we control how that spread kind of plays out a little bit. The market may have a different opinion of how it turns out, but at least we have some degree of control when we're buying. When we're selling, we're collecting that premium. That's going to be the income that we're generating from that particular strategy. We're receiving that premium when we initiate our position, but again, we're buying one option and selling another, so we still have those same rights and obligations. So credit spread, we receive that premium to initiate the position. Again, we're long one option, we're short another. We've got rights on the one hand, obligations on the other. Now, when people trade call credit spreads or a bear call spread, they're bearish, right? It's a bear call spread. So your initial leg is going to determine your forecast for the spread. We might be neutral, we might be bearish with this bear call spread. Remember, when we're selling options, that premium is ours to keep. The way that we keep it is for that contract to theoretically expire out of the money and expire without value. So when we buy options, we need something to happen. We need the market to move. We need implied volatility to change. There needs to be some impetus in the market, some reaction to change the value of the contract that we just purchased. Because if we bought it for $2, we need it to be worth more than $2 at expiration in order for us to realize a profit, right? That just generally makes sense. When we're selling options, we want the opposite to happen. We either want the market to stay as it is, right, neutral, or we want it to perform the way that our direction wants it to perform. If we're bearish and we're talking calls, we want the market to do what? Go up or down? Up or down? There we go. Thank you. So we can be neutral because that contract can still expire without value, even if the market doesn't move, and we're okay with that. Because when we sell options, the most that we can make is the premium that we collect. So we're not necessarily concerned with the market dropping with a bear call spread. What we don't want is for the market to go up. But again, with the flexibility of options, we can pair that short call, that bearish call that we're selling, we can pair that with a long option just in case, right, for protection. When we sell a call by itself, we call it a naked call, and it's the most risky trade out there, right? We are obligating ourselves to sell stock at our strike price. And I'm talking equity options. Certainly you could trade these with ETF and indices as well, index options. But with an equity option, when we sell a call, we're obligating ourselves to sell that stock at the strike price. Well, if we're selling a $50 call and stock rallies up to 500, it's probably not going to be very good for us. We're not going to be long-term traders by, making trades like that and losing money like that. But what we can do, and the reason that a lot of people trade spreads, is to have that protection. We still want to generate that income by selling the contract, but we also want to buy some protection should we turn out to be wrong. All right? I'm assuming nobody ever here has been wrong on a trade before, right? We don't need that protection. So investors, whether it's a market maker or hedge funds or individual investors, they will take their forecast of the market and choose a strategy based on that forecast, but they may also protect themselves in case things don't go quite the way that they hope to. And that's what we have with the bear call spread. So our first iteration is going to be we're selling that call because we're bearish on the market, we think it's going to go down, or we think it's really not going to move very much, and we want to collect that premium. But just in case we're wrong, we want to have that protection. So we've got defined risk and reward, right? We know how much we can make because we're selling. So the most we can make is that premium that we collect. That's going to be our defined reward. And our defined risk, in the case with this, is going to be the difference between the two strikes, which I'll get to in just a moment. But the reason that people trade spreads is that defined risk and reward, we've got a more favorable break-even point, right? When we trade spreads or when we're adding more legs to the option, it changes the cost basis of our trade. It changes our break-even point, changes our profit and loss scenario. I'm going to skip through a couple of these. The risk control, again, that defined profit potential. We know how much we can make. We know how much we can lose. But when we have option trades, it's different from stock. There was somebody that I was speaking to earlier today, and I was explaining how stock, for example, a lot of times you just kind of buy it and stick it in the drawer and forget about it. Option traders, whether it's a spread trader or if you're just buying and selling options, it's a more active type of investment, right? You need to monitor the position. You need to be engaged. I was speaking with a family earlier that they're getting their son started in the stock market and saying that they're buying stocks, for him and, with the idea of just kind of putting it away and kind of forgetting about it. And then we were talking options. And I said, well, you certainly aren't going to want to do that with options, right? You need to be an active participant. Investing with options is an active participation type of investment. So we were talking about that. So this last bullet point here, position monitoring, critical. You always want to be on top. You always want to know what's going on with your position. Let's go ahead and look at an example of what a credit spread is or a bear call spread, and it might help drive the point home a little bit easier. So here's our favorite stock, XYZ, trading $87.50, and we're going to be using this example throughout the presentation today. We've got 28 days till expiration, right? So about 4 weeks. We think that our stock is going to stay somewhat where it's trading. It's trading 87.5. We don't really see that it's going to move to the upside all that much. And if it moves lower, well, all the better, right? Because we're bearish. We want it to go lower. We think it's going to go lower. So we go ahead and we look at our options chain, and we see, for example, a $90 strike call for 28 days. We can sell it for $3.50. Now, that might be enough for you right there, right? You're bearish. You think the stock is going to go down. You can collect, $3.50, $350 per contract, put that in your pocket and be happy and hope that the market performs as your forecast dictates, right? You think it's going to go down. That should be a lot easier to say than it was. But what if you're wrong, all right? What if it doesn't go down? What if it goes up? Instead of going to $80, it goes to $800, right? That's going to be a big problem. So we're looking for protection. We're going to buy this long leg, which in this case is the $95 strike. We're going to buy that for $1.80. So we're giving back some of that premium that was really the whole point that we wanted to do the trade, right? We were looking to generate that income. We did with selling the $3.50 call. But in case we're wrong, it could cost us a lot more than that $350 that we collected when we did the trade. So to protect ourselves, we're going to buy that extra leg, the $95 strike. So just in case things don't go right and they go the exact opposite of what we want, we've got that upside protection. So we have now in place a $95 bear call spread. Again, we're neutral to bearish. We want the stock to go down. Ideally, we don't want the stock to go up. That's really more of a situation. Neutral. We don't care if the stock goes down. We don't care if it stays the same. What we don't want it to do is go up. So our forecast is still neutral to bearish. Here's our trade. We've got the $95 call spread. We sold it for a net credit of $1.70. It's $170 in our pocket. That's going to stay there regardless of what might happen with the trade. That's also going to be our maximum gain. Anytime we sell options, remember that premium we collect, that is the most that we can earn. And even though with a bear call spread, we sold an option and bought it, the net outcome is a credit, hence credit spreads. That's why we call them credit spreads. So because we're a net seller, that premium that we collect, that net premium, that's going to be our maximum profit. Our maximum risk is going to be the difference between the strikes minus that premium that we collected. Our margin on the trade, that's going to vary from broker to broker, but typically it's going to be equal to the risk that we're taking on. And our break-even point is going to be $91.70. We figure that by our short call, if we were forced to sell stock at $90, because that's where we're short, but we collected a $1.70 premium when we initiated the trade, theoretically, we're actually selling that stock at $91.70, so that's going to be our break-even point. Anything below that, we're going to be profitable, Anything above that is where we're going to begin losing money. And I'll graph that out for you to show it a little bit more visually for you. Here's our trade. Our maximum profit, $1.70. Maximum risk is going to be $3.30. And here is, if you can see my pointer, there's our short $90 call. You can see when stock goes anything below that, 85, 80, whatever, you see that line is straight, right? That's going to be our maximum profit. It doesn't matter if stock drops to zero. We're not going to be able to make any more than that $170 credit. Our maximum loss, again, it doesn't matter if stock goes up to 100 or more because we are long that $95 strike. So if stock finished at 100, this would expire worthless. Let me rephrase that. It wouldn't expire worthless. This short call would get assigned. We would be forced to sell our stock at $90. This long call would get likely exercised. We would buy those shares back for $95. So we sold it at 90, we bought it back at 95. That's a $5 loss on the stock minus the $1.70 premium that we collected up front. That's going to be our $3.30. That's going to be our maximum loss. So it doesn't matter if stock goes to 1,000, we can't lose more than that. And I kind of explained it a little bit the same here. If shares finish at or below the short strike, it would be expected that both legs expire unexercised and worthless. If shares finish $50, then I'm not going to be exercising my long call and buying stock at 95. Certainly not going to do that. That option expires worthless. My short call at 90, nobody's going to force me to sell them stock at $90 when it's trading 45 or 50 in the market, what have you. So that leg's going to expire worthless. The trade simply expires without value. No exercise, unlikely assignment. That premium that we collect, that $1.70, that's going to be our max profit. We retain 100% of that. If shares finish above the long strike of $95, our long call would exercise. We would buy shares for 95. We're still obligated to sell that stock at 90, right? So our short call would get assigned, and we lose $5 on the stock minus the premium that we collected up front. If stock finishes between strikes, this is kind of where it gets tricky. If stock finished at, say, let's say $93. Stock finishes $93. My long call, at the $95 strike, what's going to happen to that? Am I going to exercise that, or am I going to let that expire without value? Well, I'm going to let that expire, right? I'm not going to want to pay $95 for stock when it's trading $93 in the market. So I'm going to let that call expire worthless. The short call that I have, the short $90 call, it obligates me to sell stock at $90. Is somebody going to want to buy that stock from me for $90 when it's trading $93 in the market? Yeah, of course, right? So my short call would get likely assigned. My long call would expire without value and worthless. Now, what do I find myself with? I've got a short stock position, short stock at $90 when it's trading $93 in the market. So I've got a $3 loss on the stock. That's offset by the $1.70 that I collected at trade inception. But I still have a short stock position and all of the risk and all of the fees and everything that go along with short stock. So that's something that you're going to need to consider. Does your trading firm allow you to hold a short stock position? If they don't, they may force you to liquidate this trade before it hits expiration. And that brings up a point that I really want to stress throughout all of these presentations and really everything that you do while you're here at the Money Show event. Talk to your brokers. Familiarize yourself with their policies and procedures. What will they allow you to do? What will they not allow you to do? How do they handle the exercise and assignment process? Are there cutoff times for their exercise window? How do they handle non-standard options? These are all questions that you want the answers to before you need them, meaning that if a situation already occurs when you need to know the answer, it's too late to do anything about it. So these are questions that you should be asking before those events happen. Right? Does that make sense? That I think we can all agree on that. Potential risks of after-hours trading. This is kind of a little bit more about what I just spoke of. We're Chicago folk, so for us, the market closes at 3 p.m. Central Time for equities and most ETFs, 3:15 for a lot of the indices and some ETFs as well. But the market doesn't stop trading at 3 o'clock, right, or 4 o'clock for you East Coast folk. The market doesn't stop, right? And what that means is that after-hours trading has the potential to move an out-of-the-money contract, which as sellers is typically good for us, an out-of-the-money contract in the money. And what I mean by that is that if stock is trading $50 and I am short a $52 call, and I'm not even talking spreads, just an outright call. I'm short a $52 call. Stock's trading $50. My contract is out of the money, right? I have the obligation to sell stock at $52 if I get assigned. Stock's trading 50 in the market. Nobody's going to want to buy my stock from 52 when it's trading 50. News comes out after hours, earnings release, drug trial announcement, what have you, something that causes a material change in the stock price. And now after hours, that stock goes from $50 to $60. That short $52 call that I had is still out of the money, technically, but theoretically, it's now in the money by $8. So whereas I'm expecting to wake up Monday morning and have no position, expecting my option position to expire without value. The premium that I collected from that, I expect to retain. It's all in my account come Monday morning. That's my expectation. Instead, I find out that I'm short 100 shares of stock, or however many contracts I may have times 100, at $52, and the stock is trading 60. Right? So now I'm expecting maybe, in this instance with that I used with the spread, I'm expecting to see $170 of profit in my account and not an $800 stock loss. But the reality is that I do have that loss because of these after-hours trading. So it goes with spreads and it goes with pretty much any trading. It's also a reason that, good, I do have that up. It's also a reason that a lot of traders might close out their short positions prior to expiration. Right, 5-10 minutes before market close, they may choose to buy back a short contract, even though it's out of the money, for a nickel or a couple pennies or even a dime, what have you. 10 cents in the real world of options is what? $10, right? So meaning that $10 that you spend expiration Friday to close out that short position could save you tens of thousands come Monday. Now, we don't provide advice and we don't make recommendations, so I'm not telling you that this is something that you should do. What I am telling you is that it might be something worth considering. You can only be assigned when you have an assignable position. And I know it sounds, well, of course, that just makes sense. But people don't really think about it. You only have an assignable position when you're short options. If you close out those short options just prior to expiration, you no longer have an assignable position, and you no longer have any possibility of waking up, Saturday morning when you normally receive an assignment notice, or Monday morning maybe when you look at your statement. You no longer have that assignable position, so therefore you no longer have any surprises waiting for you. All right. Has anyone had that situation where you expected to, be flat stock and you come Monday morning and now you're long or you're short unexpectedly because of this unexpected market movements? I saw you had your hand up. Anybody else? No one? You had it too? Yeah, you. Yeah. So, these are realities of trading, of option trading, whether it's spreads or what have you. Again, only for short options. Long options, you certainly don't have that risk because you're in control. You decide, when and whether or not you want to exercise. But for short options, you do have that risk. So one of the ways to take that risk off the table is by completely removing it and closing out those contracts ahead of time. Because once you are assigned on that short position, there's nothing you can do. We often get emails from people come Monday morning. I was expecting my position to expire without value. Now I've got, all of the stock that I'm long or all of the stock that I'm short. And of course, they're not going to be winners, right? You're not going to be long stock at $50 when it's trading 75 unexpectedly. It's going to be the other way around. You're long 75 when it's trading 50, all right? So it behooves you to not only talk to your broker, again, as I mentioned a moment ago, they may manage that position for you. So talk to your broker about what their policies and procedures are for that, what their policies and procedures are surrounding exercise and assignment, because though that after hours trading, once you get assigned, you can't do anything. The people that we talk to, the emails that we get say that, I got assigned and I wasn't expecting, and my broker won't let me do anything about it. My broker won't let me exercise my contracts. My broker won't let me manage my position. And the reason being is assignment is the very last step. Once assignment happens, there's nothing more. That's it. End of story. So it's generally a good idea to manage that risk prior to receiving that assignment, because once you do receive that assignment, all bets are off, and you just make good on the trade and you move on to your next one. All right? Put credit spreads. We've got two sides of the same coin. There's the call credit spreads. That's going to be our bear call spread. Puts are opposite of calls. So with a put credit spread, we're talking about a bull put spread. From the name, what do we want to happen with the market? Do we want it to go up or down? We want it to go up, right? We're bullish. We're also neutral because we're selling. Anytime that we sell options, we're okay with no movement. So that's one of the things. Anytime we sell, it's typically you're neutral to blank, moderately bullish, moderately bearish, what have you. When we sell a put credit spread, again, we've got that defined risk and defined reward. We're selling options, so the most that we can generate in terms of profit is the premium that we collect. The risk that we have is the difference between those strikes. And again, we'll see that in an example how that works. But with spreads, we've got that defined risk. We've got that defined reward. We know how much we can make. We know how much we can lose. Again, we need to monitor these positions. We need to know what's happening. When we sell puts, what is the general outcome? What is the obligation of a put seller? They're obligated to buy the stock, right? Obligated to buy the stock if we receive an assignment notice. When we sell a put, we may want to buy that stock, right? There's a strategy called a cash secured put, where the ideal outcome is we actually do get assigned and we buy that stock, but we're buying it at a discount. So with a cash secured put, typically you choose an out-of-the-money strike. Stock's trading $50, maybe we sell a $45 put with the hope that we get assigned and we buy stock at $45. When today it's trading for $50. So when we do a put credit spread, our first step is to choose that strike for the short put. Where do we want to buy those shares if we get assigned? The second step is, what if we're wrong? Stock's trading $50, we sell a $45 put, we would love to buy that stock for $45. What if stock goes to zero? What if it goes to, $2? If we sold that $45 put by itself, we are obligated to buy those shares for $45. They're trading in the market for $2. Is that a good trade for us? Not at all. We're not going to be in the business of trading very long if we continue to have trades with those kind of losses. To offset those losses, and not really offset, but maybe to prevent those losses, to protect against those losses, we're going to buy protection. We're going to buy insurance. Now, it's not technical insurance, completely separate product, but the concept is the same, right? If something goes wrong, we're protected. In this case, with the bull put spread, if something goes wrong and stock drops precipitously, we've got a long put in place paired with our short put to protect us from that risk. So Stocks trading 50, we may have a short 45 strike put that obligates us to buy the stock at 45 if we get assigned, which might be what we want. But in case stock goes down below 45, we now have a long 40 strike put to protect us from $40 and below. With a bear call spread, we had the long strike works as protection should things go up. With a bull put spread, we've got that protection in place should things go down. So again, here's our scenario. Remember, stocks trading 87.5. Our favorite stock, XYZ. We've got 28 days until we expire. And we look at our option chain. Stocks trading 87.5. We've got an $85 put that's trading for $2 and a nickel. And that's our forecast, right? We want to sell that put because we think stock prices are going to go up, and we either want to be assigned in buying that stock at a discount, or we want the contract, our short contract, to simply expire without value, and we keep that premium to ourselves. So that's our forecast, that short leg. It's the reason we're doing the trade. We also add that $28, that 28-day 80 strike put just in case things go wrong. So that's our protection to the downside. Our spread is a net credit of $1.35. We've got the 80-85 bull put spread on. Neutral to bullish is our forecast. Our maximum gain is going to be what? We're selling options. How much can we make on this trade? $1.35, right? So our maximum gain is going to be limited to the premium that we collect. Just like with any selling strategy, whether we're selling spreads, condors, butterflies, or naked options, whatever we sell it for, that is going to be our maximum gain. Our maximum risk with a bull put spread is going to be the difference between the strikes minus the premium that we collected. And like I said, we'll get to an example where we show that in just a moment. And then because our risk is 365, that's what we would expect our broker to require for margin as well. Margin is going to vary for broker to broker. Obviously, contact your broker to see what their margining requirements are. And our break-even point, that is going to be our short put strike, where we are obligated to buy those shares. So if we have to buy stock for, what's our short put here? Our short put is $80. Our short put is 85. So if we're obligated to buy stock for $85, and we collected $1.70, $1.35 in premium up front, we're really buying that stock for $83.65. So if we get assigned, our cost basis for those shares are going to be $83.65. So that's going to be our break-even point. Anything below that, we're going to be profitable. Anything above that, we're going to go ahead and, anything below that, we're going to lose money. Anything above that, we're going to be profitable. Here's what it looks like graphically. We've got our $85 short put. Shares finish at or above our short strike of 85. Both contracts are going to be unexercised and unassigned. That would be our expectation. I'm short the $85 put. Stock's trading 100. Is anybody going to want to put that stock to me at $85? My 85 strike put, that short put is going to expire unassigned. It's unlikely that anybody is going to put that stock to me at 85 when it's trading 100. The second part of my trade is my long 80 strike put. I'm not going to want to exercise that and sell stock at 80 when it's trading in the market at 100. So I'm going to let that contract expire worthless. So now I've got a long put I'm letting go, expire without value. The short put is expected to be unassigned and also expire without value. That premium that I collect up front, that's going to be my maximum profit potential. I'm going to retain 100% of that. If stock finishes below, let's see, so that's at or above the stock, the strike price of 85. If we go below our break-even point and stock finishes below our strike of 80, for example, let's say stock finishes at 70, what's going to happen? Well, the 85 put that I'm short, I'm going to get shares put to me at $85. So I'm going to be buying stock at 85. I'm also long the 80 strike put, which gives me the right to sell those shares at 80. So stock gets put to me at 85. I turn around and sell that at 80. I lost $5 on the stock. That's offset by the $60 by net credit of $1.35 that I collected at trade inception. So I'm going to have a maximum loss, $5 on the stock minus the $1.35 that I collected up front. That's going to be my maximum loss of $3.65. It doesn't matter if stock goes to zero. I'm still going to be buying shares at 85, and I'm still going to be selling them out at 80. All right, does that make sense? So it doesn't matter where shares finish below that long put strike. That's my protection. That's the reason I have it. And in this case, it's working out for me. If shares finish between our strikes, between the 80 and 85, this gets a little trickier, right? Let's say we've got 80 and 85 stock finishes at 82.5, right in between. The short 85 strike put that I sold, somebody's going to force me to buy those shares for $85. They're trading 82.5 in the market, so I lost $2.50 on that stock. My long $80 strike put, I'm not going to exercise that. Sure, I can sell my stock that was just put to me. I can exercise that long put and sell those shares at 80. Yeah, I can do that. Or I can sell it just outright at 82.5 in the market where it's trading. So likely that long put is going to expire without value. Now I find myself with the long stock position, long from $85, and wherever I liquidate that, whether it be at 82.5 or below, or maybe I just hold the position and wait a little bit. Either way, wherever I finally liquidate that stock position, whatever profit or loss on that stock is going to be, I'm going to take the premium that I collected when I sold the contract, and that's going to be my net profit or loss. And that is a bull put spread. Iron Condor is going to be a pairing of a bull put spread and a bear call spread. With a bear call spread, our motivation, or I should say our forecast, is neutral to moderately bearish, right? Hence the bear call spread. With a bull put spread, we are neutral to moderately bullish on the underlying. The common denominator in there is what? Neutral, right? We don't expect a lot of market movement. With an iron condor, it puts the two together, and we're looking for very limited, if any, price movement in the underlying stock. So what we do is we take our put credit spread, right, our bull put spread, neutral to moderately bullish. We take that and we pair that with our bear call spread, neutral to moderately bearish. So we take the two spreads together. It's a four-leg strategy. We trade it under one ticket, typically when we initiate an iron condor. We're selling a bear call spread. We are selling a bull put spread. So four legs together. That's going to be our trade. And what we get is the iron condor. And here's an example. Again, 87.5 is going to be our stock price. We got 28 days to expiration. On the downside, we don't expect shares to drop below 85. On the upside, we don't expect shares to eclipse 90, right? There's our range bound. That's where we want those shares to finish. So on the upside, we've got our maximum target of $95. Just in case we're wrong, remember, we're selling a spread. So we think that the stock range is going to be between 85 and 90. That $90 upper price limit, that's going to be our target where we sell our short call. Just in case we're wrong, we're going to buy that insurance. That's going to be a 95 strike call. Let's see if I have those here. So with our call spread, $90 is our target. $95 is going to be our long option just in case we're wrong. On the put side, $85 is going to be the bottom end of our target. We're going to buy an $80 put, again, just in case we're wrong. All right? Nobody's ever right 100% of the time trading options. Most people are right significantly less than that. So for protection, it's, we like to make sure that we're covered just in case things don't go the way that we expect. So a typical iron condor generally has equidistant call strikes and equidistant put strikes centered around the underlying. It doesn't have to be that way. You can skew either leg, so you can trade a more narrow or a wider range on the put side. You could trade a narrower or more wider range on the call side, and then you could skew it around the stock price. You could, move the puts closer to the at the money. You could move the calls closer to the at the money, depending on your overall opinion. Maybe you're not so much neutral as you are a little bit more neutral to bullish, so maybe you skew your calls a little bit. But the point being is that they're typically structured with puts equidistant and calls equidistant, not only from each other, but from that center stock price. And in our example, we've got the 80-85 put spread. We sell that. We sell the 90-95 call spread. Because we are selling two spreads, theoretically, we get double the premium. So now we can sell both of those and collect over $3 or over $300 in premium for the contract. Because we're net sellers, right, nothing changes. That net sale price is still going to be our maximum profit. The risk that we have is going to once again be the difference between the strike prices minus the premium that we collected. Now, the interesting thing about a condor is that you can only win or lose at, on one side. So meaning that you're never going to lose on the put side and the call side at the same time. You're never going to profit on the call side and the put side at the same time. Only one of those spreads are really going to be in play. But the reason we're trading both of the spreads is because we don't necessarily know, or for that matter care, which direction the market goes. If the market moves a little bit up, or if it moves a little bit down, we can still profit both ways. So that's why we're trading both of those spreads at once. And it's also because we have that range. We were expecting the stock to trade within that 85 to 90 range. Thank you. Here's our graph, right? We take the two profit and loss graphs, we put them together. You can see how it's centered around the stock price. That's going to be our orange line centered around the stock price of 87.5. You can see if we move up a little bit, we're still in the profit. If we move down a little bit, we're still in the profit. If stock stays between those two short strikes, between the 85 and the 90 strike, that's where our maximum profit is. That's where we retain 100% of this premium. Our break-even points, 93.05 on the upside, 81.95 on the downside. Any place in between those two break-even points, we're still going to be profitable. And remember, we were expecting the stock to be range-bound. We were expecting it to stay between 85 and 90. Well, it turns out with this trade, we're still going to make money even if it stays between roughly 82 and 93. So we've got a little bit of extra cushion where we can still make money. But if we're wrong, one leg of the spread, let's say we finish between the call strikes. All of the put strikes would expire without value and unexercised, likely unassigned, and that's done. So now all we have is the call side to worry about. So if stock finishes, between $80 and $95, let's say it finishes 94, we're going to have a stock position. Our short 90 call is we're going to be forced to sell our shares at 90. Our long $95 call is going to expire without value. So what do we have left? We've got a short stock position from $90. Shares are trading 94. $4 loser on the stock minus the premium that we collected when we initiated the trade, and that would be our profit and loss based on a $94 stock price. But anywhere in between those strikes, whether it's on the call side or the put side, we're either going to be long stock or short stock, and we would have to manage that position accordingly. The iron butterfly, similar to an iron condor where it's a combination of two strategies, the iron butterfly is the same. Some people look at it as a combination of a call credit spread and a put credit spread. So selling a bear call spread, selling a bull put spread. I like to look at it as a difference in straddles and strangles. A short straddle is where you sell a call and sell a put of the same strike and same expiration. A strangle is where you're, in this case, a long strangle. You're buying a call and you're buying a put of different strikes, but you're buying both options, same expiration. Either way that you look at it, whether it's a combination of the credit spreads or a short straddle and a long strangle, you still have that same objective of the range-bound trading. You want the stock to trade within a narrow range. And because your objective is for everything to expire worthless. When we sell options, we want to keep 100% of that premium. And the way to do that is for all options to expire unexercised, unassigned, and without value. So here's an example that we've got 28 days to expiration, stock trading 87.5. Our expected price range is $85 to $90. That's where we think the shares are going to end up at expiration. So what we can do is the straddle in the middle of our range, 85 and 90, 87.5. That's going to be our middle point. We can sell the $87.5 straddle, and we could collect $6.90 for it, almost $7. Because we're selling an at-the-money call and we're selling an at-the-money put. That's typically how straddles work, at-the-money options. For protection, again, because we're not always right, for protection, we are going to purchase a strangle. So if you were to look at a straddle, the profit and loss on a straddle is like an upside-down V. The center point, the top point, that's going to be the at-the-money. That's the at-the-money strike. But there's no protection to the upside. There's no protection to the downside. We don't like that. We don't like no protection. So we're going to buy a strangle to turn those endpoints kind of out. So we're going to buy the $80 strangle, $80.95 strangle. It's going to cost us $1.80. We're going to give back some of that premium for protection. $5.10 is going to be our net credit on the trade. That's, again, going to be our maximum profit, our maximum gain. Our maximum risk is going to be $2.40. Break-even points, 82.40 on the downside, 92.60 on the upside. Very similar to like an iron condor. You take your short option and you're going to add or subtract the premium that you collected on the trade to figure out your break-even points. And here is what our profit and loss looks like. Again, we've got that 87.5, that's where stock is trading. This is our at-the-money straddle, the upside-down V there. And here's our protection. So if shares finish below 80, we've got protection to the downside. This is where that strangle kicks in. The long put on the strangle, the long call on the strangle here if shares finish over 95. Those long options are added for our protection. So in case we are wrong, we've got some built-in protection. If shares finish at 87.5, we would expect all legs to expire unexercised and without value. In this case, we would retain 100% of that premium that we collected. That $5.10, it's in our pocket and it stays there. If shares finish between our strikes, our long strikes of 80 and 95, one of those short legs is going to be in the money, and it's likely going to be assigned. That would then correspond to either a long or short stock position. Our break-even point, or I'm sorry, our profit and loss is then going to be determined by where we liquidate that stock. If we're short stock, where do we buy it back? If we're long stock, where do we sell it? It's all going to depend on that liquidation point. If shares finish between our strikes of 80 and 87.5 on the put side, or 87.5 and 95 on the call side, one of those legs is likely going to be exercised, or one of those legs is likely to be assigned. Again, we've got a long or stock position, and our profit and loss is going to be determined by where we get out of that stock. So an iron butterfly combination of for me, it's easier to understand it as a combination short straddle, long strangle. You could also look at it as a combination of a bear call spread and a bull put spread, with the short strikes being the same of the bear call spread and the bull put spread. That's an iron butterfly. That's it for the credit spreads. We will be around for questions.
Hi, everyone. I hope you enjoyed being a guinea pig for our first live stream of a previous event that we had back in Orlando. So thank you for your patience. We're still working out a couple kinks, but we think it worked out pretty well. And now we're going to do some live Q&A and answer some of the questions that came in. Here's one that came in. In your opinion, what is the biggest difference between debit and credit spreads? They both have some of the same characteristics. One of the reasons that people trade spreads is because of defined risk and defined reward. The way that I like to explain debit spreads to start is that your long leg indicates the direction that you want to go. So if you're bullish, you would buy that call option. But by purchasing that call option, it gives you the right to participate in any upwards stock price appreciation from your strike price all the way to infinity, theoretically, right? There's no ceiling on how high stock prices can go. Now, that being said, what is the likelihood of that stock actually going to infinity? If maybe you're only predicting a 10% increase or a 20% increase, what have you, why pay for all of that extra room that you really don't need? So that's why we sell a call, or we would sell a put against our long option to allow us to benefit for the stock price appreciation or depreciation, if we're talking about puts, that we're expecting. So we're not paying for more than we really need. Kind of similar that if you're trading for an event like an earnings announcement or something that's happening in 3 weeks, that you wouldn't necessarily go ahead and buy an option expiring 2 years down the road, right? You're paying for more than what you actually need. Kind of the same thing with that debit spread. That's why you sell that short option. Credit spreads are going to be the opposite. That short leg that you're selling, that is going to be your forecast. You think the stock is going to drop below $50, so maybe you sell a $50 call. But just in case you're wrong, as I had mentioned repeatedly throughout the presentation, just in case you're wrong, we like to have that protection. So to me, the difference between debit spreads and credit spreads, outside of you're paying for one, that would be the debit spread. Credit spread, you're collecting that money. So outside of how that money changes hands, with the debit spread, that short leg or that additional leg acts as a reducement of the money that you're actually paying out. Whereas for a credit spread, it is for protection should your forecast be wrong. So let's see another question here. Can you explain a little bit more about that after hours trading risk? Certainly. And this is a topic that I try to hammer home to investors. And the reason being is a case that I addressed earlier today with an investor that spoke via email. He had on a covered call where he was long the stock and short a call option. The stock was after the market closed on Friday, the stock was added to, I believe it was the S&P. So whereas the stock closed at roughly 177.5, and this gentleman was short the 182.5 calls and the 185 calls, because he was anywhere between $5 and $7.50 out of the money at market close, he figured, well, these covered calls, these call options are simply going to expire worthless. I hold on to my stock, and we reassess Monday morning as to what he would like to do. When the stock was added to the S&P, it jumped from 177.5 almost up to 190. So even though those short calls technically expired out of the money, theoretically they became in the money due to the after hours trading. He woke up Monday morning and found an assignment of both the 182.5 and the 185 calls that he wasn't expecting, and now the stock was trading in the 190 range. So what he was expecting as a short call that would basically just expire without value, and whatever premium he collected from that would be his to keep, and waiting for him Monday morning in his account turned out to be the opposite. Now he was short, several thousand shares of stock on a stock that was, increasing in value. So that's how after-hours trading can affect the option. The solution to that, or a potential solution to that, and it's one of the reasons that market makers, professional traders, for example, they will close out those short options prior to expiration. Whether it's trading for a few pennies or a nickel or a dime, they will go ahead and buy back those short options, whether it's a short call or a short put, to take that expiration risk off the table. As kind of redundant as it sounds, you can only be assigned on an assignable position, meaning that if you're not short options, you cannot be assigned no matter what happens. So if just a few minutes prior to close, a half hour, an hour, whatever it may be, prior to the close of business, regardless of how far out of the money your option may be, a seasoned investor may choose to buy back those short options simply to take that assignment risk off the table. Remember, in the real world, assuming we're factoring in a 100 multiplier, it's $5 of real money. So had this investor simply closed those contracts, and as far out of the money as they were, I would expect they'd be trading for a nickel or less. So maybe $5 per contract, he could have completely eliminated that risk that greeted him Monday morning, sadly. So that's kind of how after hours trading works, how after hours risk works, I should say. So you might want to, maybe even have a conversation with your broker to see what their opinion is as to whether or not closing out that position would be warranted. Another question, what is the next live event? Next, a week from today, so next Wednesday, my partner Matt Cashman is going to be presenting his, what did he do? Using Greeks, or using metaphor to explain Greeks. Matt and I were at Orlando at an industry event where I presented the credit spreads. Matt presented the using metaphor to explain Greek. So he's going to be sitting in my seat next week and doing the same thing that I am now. As to other live events, in-person events that we do, we don't really do them very often anymore, outside of maybe industry trade shows. We've got one slated in February in Las Vegas. It's going to be a money show event, but outside of that, I'm not sure if we have any others on the table. Here's another question. Why is assignment allowed to continue when the market is closed? So an interesting thing, this is back to the after hours. An option technically doesn't expire until 11:59 p.m. Eastern time. The market obviously closes, considerably earlier. But when the market closes and the exchanges and OCC process all of the opening trades and then all of the closing trades, the next step, once we know what that existing open interest is at the end of the day, the next step is the exercise process. So any investor who's long can go ahead and exercise their contract. After all of those exercise notices are sent out and processed, the assignment notice is going to be that last step. So what that means is if you receive an assignment notice, it is now too late to do anything. It's too late to manage your position. It's too late to buy back those options to close. It's too late to do anything other than fulfill that assignment. As to why is that allowed to continue? Well, that's just simply how the market works and has worked for the last 50 plus years. SEC rules and exchange rules govern how all of that comes into play. But that is simply the risk of selling options. You can be assigned at any time for any reason, and after hours trading is certainly a risk. Now that's unfortunately that's what we've got for you today. Not unfortunately, I'm very happy that we were able to present what we had, the credit spreads, but that is the time that we have. There were a number of questions that came in last minute. We will be responding to those directly tomorrow. So keep an eye out of your inbox, your email inbox, because we will be contacting you, thanking you for attending, thanking you for submitting your question, and providing an answer for you. What I would also like to do is encourage you to fill out the survey once we end this presentation. Fill out the survey, let us know not only what you thought about the topic, not only what you thought about my presentation, but let us know what you thought about this live event and this rebroadcast of our live event. It's something that we're hoping to do more of in the coming year. So let us know what you thought of it, whether it worked, whether it didn't, what you liked, what you didn't like, etc. So do us a favor and just drop us a note and give us your thoughts. With that out of the way, it's going to do it for me for 2024. For those of you that are regular listeners to my Wide World of Options podcast, certainly thank you for supporting that. For those of you that are active listeners and attendees of our OIC Option series, our webinar series, again, thank you for your support. We certainly appreciate it. Very much looking forward to seeing you again in 2025, where we've got some more great content and some new things in store for you. So we certainly hope you enjoy that all. Meantime, if you have any questions, reach out to us, email at options@theocc.com. And I hope everyone has a wonderful holiday and a very, very, very happy and healthy new year. Take care, everyone, and we'll be talking with you again very soon.